If you are a Canadian senior who owns a home right now and you have been counting on that home as your retirement nest egg, your safety net, or the inheritance you plan to leave your children, there is a CRA property compliance shift in 2026 that most Canadians have absolutely no idea is happening, not a minor administrative update. A fundamental shift in how the CRA is treating the kinds of transactions that millions of ordinary Canadian seniors make every single year. Adding a child to a title, moving a property into a trust, selling a family cottage, downsizing after decades in the same house. Every one of those decisions that felt completely straightforward for generations, is now being examined more closely than at any point in recent Canadian history. And the seniors getting hurt the most are not the ones who tried to hide anything. They are the ones who simply did not know the rules had changed until the CRA letter arrived in their mailbox. Stay with me, because by the end of this video, you will know exactly what changed, who is most at risk, and the steps every Canadian senior homeowner needs to take before this affects their savings, their home, or the legacy they plan to leave behind. Before I get into it, this video is for educational purposes only and is not tax or legal advice. Always consult a qualified Canadian tax professional before making decisions about your property. Tell me in the comments right now, have you made any changes to your property ownership in the past 3 years? Added a family member to a title? Transferred a property? Updated an estate plan? Yes or no? Drop your province below. Because what this community is reporting right now is something every Canadian senior homeowner needs to hear. Subscribe and turn on notifications now, so this information always reaches you before the CRA does. Douglas is 69 years old. He retired after 31 years as a civil engineer in Kelowna, British Columbia. He and his wife Patricia have lived in their home for 26 years. They bought it in 1999 for $280,000. Today that same home is worth $1,100,000. Douglas and Patricia are not wealthy investors. They live on CPP OAS and a small workplace pension. Their home is their retirement, their safety net, the one asset they planned to transfer to their daughter when the time came. Last spring, their financial planner suggested they add their daughter Claire to the title, a common estate planning strategy designed to avoid probate and simplify the eventual transfer. They went to a lawyer, the paperwork was signed, the family felt relieved. What nobody told them was that adding Claire to the title triggered a deemed disposition under the Income Tax Act. In the eyes of the CRA, Douglas and Patricia had just transferred 50% ownership of a property worth $1,100,000. The CRA treats that transfer as if they sold 50% of the home at full market value on the day the title changed. 50% of $1,100,000 is $550,000. Their adjusted cost base was $280,000, 50% of which is $140,000. The deemed capital gain on that single title change on a home they still live in on a transaction where no money changed hands was $410,000. 8 months after the title change, a CRA review notice arrived. Douglas told his neighbor afterward, "We were not trying to avoid tax. We were trying to help our daughter. Nobody told us signing that paper would look like a sale to the CRA." And the worst part, Douglas and Patricia are not unusual. Across Canada right now, senior homeowners who added a child to their title, transferred a property to a trust, or gifted their home to a family member, believing it was a simple act of love, are inside CRA reviews they never anticipated. Now here is where it gets really interesting. And honestly, this next part is the reason this video exists. The CRA has significantly expanded its property compliance framework in 2026. And there are 3 specific areas where ordinary Canadian senior homeowners are being caught right now. Tell me in the comments right now, did you know that adding a family member to your home title could trigger a capital gains event? Yes or no? I am reading every single comment. Area 1, deemed dispositions on family property transfers. A deemed disposition occurs whenever ownership of a property changes, even if no money changes hands. Adding a child's name to your title, deemed disposition. Transferring a cottage into a family trust, deemed disposition. Selling your home to your son for $1, deemed disposition at full market value. In every case, the CRA treats the transaction as if the property was sold at its current fair market value. If the principal residence exemption does not fully cover the resulting capital gain, the difference is taxable income in the year the transaction occurred. And here is what has changed in 2026. The CRA's ability to identify these transactions has dramatically improved. Land registry data, bank records, and tax filing information are now being cross-referenced in ways that were not technically possible several years ago. Transactions that went unnoticed in previous years are now being flagged in months. Area 2. Principal residence exemption documentation requirements. Most Canadian seniors believe that because they have lived in their home their entire life, the exemption automatically and completely protects every dollar of their gain. For straightforward situations, that is largely correct. But several specific situations are producing partial exemptions that homeowners never anticipated. If you ever rented out any portion of your home, a basement suite, a secondary unit, and reported that rental income on your return, the CRA may challenge the full exemption on the rented portion. If you owned a vacation property at the same time as your primary residence, the cottage gain is fully taxable as capital gain unless a strategic principal residence designation was made before the sale. None of these situations involve deliberate avoidance. All of them are producing unexpected bills for seniors who assumed the exemption was automatic and complete. Area 3. The reporting requirement most homeowners still do not know about. Starting with the 2016 tax year, every sale of a principal residence must be reported on the tax return for the year of sale. The gain must be calculated. The exemption must be formally claimed on Schedule 3. This applies even when the full gain is exempt, even when zero tax is owed. A homeowner who sold and filed a return with no reference to the sale, assuming tax-free meant nothing to report, is receiving CRA reassessment notices right now, identifying the sale through land registry, cross-referencing, and assessing the full capital gain as taxable income because no exemption was formally claimed. Now let me show you 3 real situations, because what is catching the most Canadian seniors right now is not dramatic tax avoidance. It is ordinary family decisions nobody told them had CRA implications. Scenario 1. A retired couple adds their adult son to the title of a home that has appreciated from $200,000 to $900,000. The deemed disposition on 50% of that appreciation is $400,000 in deemed capital gain. Because the son has never lived in the home, he cannot claim it as his principal residence. The taxable portion produces a significant bill on a transaction where no money changed hands. Scenario 2. A retired widow who rented her basement suite for 7 years, sells her home, and assumes the full gain is tax-free. The CRA challenges the full principal residence exemption based on the self-contained suite that was rented. A portion of the gain is assessed as taxable. The resulting bill is $11,000 on a sale she believed would cost her nothing. Scenario 3. A Canadian senior sells the family cottage purchased in 1984 for $22,000 for $480,000 in 2025. The full capital gain is taxable because the cottage was never designated as a principal residence. What the family did not know, what could have significantly reduced that liability, was a strategic designation strategy that allocates specific years of the primary home's exemption window to the cottage. After the sale, the planning window is permanently closed. 3 ordinary families, 3 unexpected tax consequences. And in every case, the homeowner who understood the rules in advance had dramatically better options than the one who discovered them through a CRA letter. Now I want to speak directly about something. The CRA's expanded property compliance framework is real. The deemed disposition rules are real. The reporting requirements are real. The increased data matching is real. But here is what is also real. The average Canadian senior holds between 60 and 80% of their entire net worth inside their home. This is not just real estate. This is your retirement, your children's inheritance, everything you built. And in this compliance environment, the homeowners who protect that wealth are the ones who understand the rules before they make a move, not after. Here's exactly what to do right now. Step 1. Before you add any person to the title of your home for any reason, speak with a qualified Canadian tax professional first. Ask specifically about the deemed disposition that will occur and whether the principal residence exemption will fully cover it. This conversation must happen before the paperwork is signed, not after. Step 2. If you sold a property in the past 5 years and are not certain Schedule 3 was included on your return, log into your CRA, myaccount@canada.ca, and check. If it is missing, contact a tax professional about a T1 adjustment. The amendment window is 10 years in most circumstances. Step 3. If you own a cottage or vacation property and are considering selling, speak with a tax professional now about the principal residence designation strategy. Once the property is sold, the planning window closes permanently. Step 4. Document your principal residence history today. Utility bills, property tax statements, driver's license address history, voter registration records. This documentation is your protection if the CRA ever challenges your exemption. It is significantly easier to gather now than after a letter arrives. What surprised you most from this video? The deemed disposition on a simple title change, the documentation requirements on the principal residence exemption, or the reporting requirement on a tax-free sale. Drop your province and your answer in the comments below. I read every single one. And if this video helped you understand something you did not know before, hit the like button right now. 1 second. It is the only way this reaches the next Canadian senior who's about to sign paperwork without knowing what the CRA will see. Douglas and Patricia are working with a tax professional on their situation right now. They have options because they found out before the situation became unresolvable, Patricia said to her daughter afterward. We signed those papers thinking we were protecting you. If someone had told us what the CRA would see when we did that, we would have found a different way. That is exactly why this video exists. You now know what the CRA sees. You now know what to do before you sign anything. Protect your home, protect your savings, protect what you spent a lifetime building.